I'd just like to take a moment and talk about a question that we get asked frequently as it relates to 401k contributions. And the question is, should I use a traditional 401k where the money goes in pre-tax, or should I use a Roth 401k where the money goes in post-tax but comes out tax-free? It's a little bit of a complicated question, but here's a couple of ways to think about it. It really depends upon your income now and what your income is going to be later. So as an example, if you're just working, you're not making a lot of money, you're not in a high tax bracket, that sort of thing, it might make sense to choose the Roth 401k option because you're not getting much of a tax benefit for those 401k contributions anyway. And then later, the money will come out tax-free, and of course, who knows what your tax rate might be at that point, but you know that it's going to come out tax-free. On the other hand, if you're making a pretty good income and you're paying tax at a pretty healthy rate, it might make sense to make pre-tax contributions. But sometimes these pre-tax contributions aren't all that they're cracked up to be, because even though you're being taxed on less income, or at least in the amount of the contribution, you're going to have to take required minimum distributions later at age 72. So those required minimum distributions, if you have large IRA accounts, can be substantial and can then force you into a higher tax bracket in retirement. So that's one of the facets. But now, the other interesting twist to this is this passage of the Secure Act back in 2020, because the Secure Act used to allow, I should say prior to the Secure Act, it used to allow that your IRA accounts and 401k accounts could grow. You could pass them to beneficiaries. They could make inherited IRA accounts out of them and not be taxed for generations on this money. But that's no longer the case since the passage of the Secure Act. Now these IRA accounts, pre-tax IRA accounts, need to be emptied within 10 years after a person's death or after a couple's death. So if you think about it, if you end up with millions of dollars in 401ks and IRA accounts, and you have a couple of children, and the money has never been taxed, and now something happens to you, they get the money, they're going to have to pull out of the IRA account at a fairly substantial level in order to get all the money out within 10 years. So Roth 401k accounts are a very interesting alternative. We've done some studies on it in looking at that versus pre-tax contributions, considering the required minimum distributions, considering the Secure Act. And honestly, we're finding now that there's not much of a difference at all between your Roth 401k net after tax and your regular pre-tax 401k. So we'd be happy to explore what those options are for you and do some computations around it to help you decide what is the best optimal way in which to put money into these either pre-tax or post-tax accounts.